Is there's a way we can pay off our mortgage as quickly as possible? I think there is a method. The method is very simple actually. It's a financial system called Velocity Banking. What it does is basically you go to the bank, get a HELOC, and use that HELOC to pay off your mortgage a little bit faster. In a lot of cases, there's a way to pay off your mortgage a lot more quicker than 30 years. And I think in some cases, people actually have paid off their mortgage in like 7 to 8 years. So how does it work? And what are the details and intricacy we have to do, or the method which is utilized? I'll explain this in this video. So first off, we have to go to the bank. The HELOC is basically a home equity loan line of credit, which we have to get it from the bank. Once we have that line of credit, it will be a certain number, right? Let's say it's $10,000. So out of that $10,000, we know that it works as a credit card, but we can also pay our bills. Usually in credit cards, we don't have that ability. But with a HELOC, there's a way to pay off any debt we have. However, a rule of thumb is usually what I recommend is use 33% of that money to actually pay off your mortgage, right? Now, keep in mind, I'm not a financial advisor. I'm just sharing an information which I've learned and read some books about it. So I think it helps you. Before I jump in and explain how the method works, I want to address some key things before somebody start adopting this method to pay off their mortgage. There's of course some drawbacks. Some of the drawbacks are you're actually increasing your debt. That means you are actually getting a line of credit which you have to pay an interest for it. The second is the interest cost might be a little bit more initially, or over time there is a period of where your interest rate for the HELOC and your interest rate for your home matches, and that's when you have to get off. So that's a critical step, and we always have to keep updated on especially on a chart where you create your how much you're going to pay every month, and you have to keep that track so that you're not like reaching that threshold for interest rate, so that you're not double downing on the interest instead of just paying one. The second is the risk. You have to be very consistent on this. If you lose your income, that might take a huge effect, especially on the HELOC, because you're actually trying to pay that a lot quicker. The third is the opportunity cost. Of course, you have to be very consistent and have a good understanding of that I have to make this payment every month, and that could be you won't be able to invest on other investments if you want to. So you have to make sure your money is tight. This works basically, you have to understand your financial situation a lot better, so that if there is any issues or something like comes up, it's life, so that you are already covered at that aspect, because this is going to leverage all of your credit. So it is key that we actually do our homework first before implementing this step or this financial system. I also recommend to hire a consultant who can actually help you with this. There is a lot of people out there who can actually draft and understand your financial situation and help you guide that system. All right, so having explained that as at least the downside, let's jump into how it's actually possible. So once we get a HELOC, we take that HELOC and use that HELOC account as our checking account. Because once we do that, what happens is that every money which is coming in, instead of depositing that money on the checking account, we're putting it on the HELOC. So the HELOC works as if it's a checking account. So if we pull out money from there and we pay a little bit more on the mortgage, right? And we have to like pay some bills from that account, or we have to purchase something, we use that account. And every month it restarts, because the interest on that credit line is per day instead of like a mortgage which goes forever. So it's calculated differently. So you have to make sure that you understand how much interest you're paying every month, how much your bills are. So what we have to understand here is that there are a couple of things we have to keep in mind. First is the income, how much income we're bringing in. Second is the expenses of, we have to stick to a budget, especially on this case, and see how much expenses we have every month, and also calculate the cash flow, which is the leftover money after paying the expenses from the income. So once we have that, we have the list of payments calculated, how much our mortgage is going to be, how much our HELOC is going to be, how much interest we're going to pay on the mortgage and the HELOC. So once we have that calculated, we can at least figure out that, okay, this is the extra amount I can pay on the mortgage, and try to accelerate the payments and the principals so that we don't need to pay the mortgage for 30 years. So that's a very simple method. There's a lot of tools out there online, also spreadsheets. If you need one, just let me know. I can Google something for you or type up one myself. I hope this video actually helped you guys. If you like the video and found some value, please do subscribe, and I'll see you on the next one. Thank you.